Hi everyone. I'll just go through quickly on the fixed income markets, what happened, what do we expect to see, and what we are monitoring right now, as well as talk about some of the strategies we are taking on to protect our portfolios at this point in time. So if you can look at page 16, this table gives you the yearly returns for the various markets. And you can see that the sell-off in the bond market has been very, very severe. Pretty much wipe out the very strong performance we saw in 2019, right? And I'll go through a little bit why is this so. But basically, just like the equity markets, the economic shock to the system, right? Because we have a sudden shock from demand and supply due to COVID. And on top of that, we also have the oil price correction because of Russia and Saudi trying to flood supply into the market. So you can see here that even various asset classes such as government bonds as well as gold were also sold off at this period of time. So in the next few charts, I will explain more about what happened. On the next slide, this is a chart to show you the credit spread of how corporate bonds have performed. So when the credit spread widens or increase, as you can see here, it means that there is stress in the market. Okay, and credit spread actually widens significantly in the last 2 weeks, as you can see here. And where are we now in terms of credit spread? Right, this is charts that is showing you Asian credits. For the investment grade bonds, the credit spread has widened to over 400 basis points. Whereas on the high yield bonds, it has crossed about 1,000 basis points. So 1,000 basis points will signal that they are in distress. Okay, so you can see that across the markets, this is the trend that we are seeing. And among some of the more weaker names, that is probably like US energy sector, or the airline sector, some of the bonds are trading at over 2,000 basis points. So the number of bonds that are in distress now is over 2,000 names globally, compared to just about 30 names at the start of February. So the sell-off is very, very significant. Okay, and what happened? What was this driven by? In the next slide, would explain what happened here. So number one, we saw very large outflows from fixed income funds. You can see from the chart on your right that tracks emerging market retail bond flows, and the retail bond have been enjoying a lot of inflows since 2019 and 2020, but just in the last 2 weeks or so, there was a sharp withdrawal from the market. So this caused fund managers to liquidate the fixed income holdings that they have. On top of that, it is made worse by all these leverage products that is offered by private banks and a lot of retail banks on their fixed income assets as well. So what happened is when you have bond price falling, a lot of this leverage need to be unwound. And this caused even more forced selling on some of this segment, especially so in the bank AT1, or what we call perpetual markets, as well as the high yield markets. So just to give you some color, some of these AT1 names have been sold off by about 40 to 50%. So that is very significant, comparable to 2008 during the financial crisis. The other reason why this happened is because when everyone is rushing out the door, what you realize is that there is no buyer on the other side. After 2008, regulators around the world has been tightening the banks to ensure the banks are taking less risk, which is a good thing, building up their capital. But on the downside is that a lot of these banks are now not able to take on too much risk on their balance sheet, and hence not able to hold large level of bond inventory. So they are not going to buy the bonds for their own books as well. So that created even less buyers in the market. So what happened is the sell-off in AT1s and high yields caused the market to be stressed. And if fund managers can't sell those bonds, they turn to selling investment-grade bonds. So investment-grade bonds were also sold off aggressively. And that market also became dysfunctional. And then they go into the government bond market. So this sell-off actually affected all various markets, and it's a global phenomenon, right? We are seeing that trend not just in US, but in European bonds, in Australian bonds, but to a more limited extent in the Malaysian markets. So as the credit market freeze, then, you know, this is one of the biggest concerns that the central banks around the world have, because from this credit crunch or the liquidity crunch, it could very fast turn into a real financial crisis. Because if the bond issuers are not able to roll over or repay their debt, then you will have massive credit risk. And that's why in the next chart, you can see that we have the policies that has been announced by all the central banks and to address some of the very stressed market condition. So there's a few things that central banks are doing. Number one is, of course, providing rate cuts into the market. The rate cuts not only will support growth, but also to reduce the borrowing costs for a lot of these issuers. But rate cuts alone is not sufficient, right? They need to address the key problem is that there's no buyer on this other side when there's a huge withdrawal of credit. So what happened is we have seen the return of QE, and the Federal Reserve last weekend announced a very large QE, which is unlimited. So they are committed to buy unlimited amount of bonds from the market, and not just in government bonds, but this time also targeting to buy corporate bonds directly. And I think this is a very important step by the Fed to provide liquidity and to stand in as a buyer for the investment grade bonds. And that's why, like what David mentioned earlier, since then we have seen some stability in the bond market, because now there is a real buyer to stand in and the market starts to function a little bit more normally now. We have two central banks now who have embarked in QE to buy corporate bonds. But other governments such as Australia and New Zealand has also announced QE to support the government bond segment as well. So this has helped a lot to reduce the liquidity crunch and to provide support to the market. On top of that, there's also swap lines that has been established by central banks to help each other to ensure there's sufficient US dollar liquidity in this time. And of course, you know that central banks are injecting liquidity to banks to ensure that the banks are able to also provide lending to companies as well as individuals. So there has been a lot of policies been announced to help the bond market. The question is this enough? Definitely the initial part of the response, it did not calm the market until the Fed came out with the unlimited QE. And that seems to have worked. But like what David mentioned, we may not be out of the woods totally, because the major economies like US and Europe are still at the beginning of the acceleration of COVID cases. So we need to get past that period, which could take about 4 to 8 weeks from now. My final slides talks more about what we are going to monitor for the fixed income market. And there's a lot of uncertainty, of course. Number one, to the how deep and how long would this COVID impact on economies will be, right? Definitely, we know that we are already in a recession. It's a very sharp and fast one. We will expect significant drop in activities in the second quarter. due to all the lockdowns globally. And of course, we have to watch employment numbers and how the corporate sectors are doing. We are monitoring that and the SME sectors. And we are monitoring the COVID infection point on the peak of infection, the treatment timeline as well as what we mentioned. And our base case is that I think a lot of these economies would likely to lift their lockdown by May, right? To normalize and to see some economic activity to start to normalize gradually, like what we have seen in China. But of course, the risk is that if it's prolonged longer than May, then we might see that the government needs to do another round of stimulus to sustain the economy or prevent it from going worse. Okay. Secondly, we are monitoring how the policies are evolving and how the markets are responding. So like I mentioned, the last 1 week, we have seen significant amount of policies. The $2 trillion fiscal package is a huge one. I think it's about 10% of US GDP. So that has, in a way, regained some confidence by market players as well. And we are also monitoring the liquidity of the bond market. And that has also improved, right? So next thing we are watching is on portfolio flows and how much more outflows are we going to expect. There is some good news on that front that we are seeing some small inflows into some of the ETF for the fixed income markets this week after the massive bond correction. As the market in the high yield market has corrected more than 20%, there are some investors coming back in. The other part we are monitoring, of course, is the unwinding of the margin or the leverage selling by private banks. It does seem like the bulk of the selling is done, but we are still monitoring this situation. Definitely, a lot of these bonds are looking attractive from a price point, and that's why we were talking about nibbling into the market now. But again, not aggressively because we might be in for a longer run. The next two things are also very important, is that the funding risk of issuers. Are they able to roll over their debt and to refinance that debt? I think in this, like I mentioned, governments are very well aware how important it is to ensure that we don't get huge collapse or huge defaults by the big players. We will definitely see some that might go bankrupt or might default on their loans or their bonds, but we do not want to see it going to affect the financial system. Yeah, and we mentioned earlier as well, this week we have seen some encouraging sign that US and European investment grade issuers have been able to come back to the market to issue bonds after the Federal Reserve embarked on QE. And in fact, the demand for the bond is very, very strong. So this is very encouraging. Most of these bonds are seeing demand of 5 to 8 times oversubscription. So although the issuer have to pay up a little bit more to issue in the current market, but the good thing is they are able to issue their bonds as well. The other sector that we like and we are comfortable is on the Chinese issuers, because even in the last 2 weeks when the global market is so stressful, a lot of these Chinese issuers are still able to tap the domestic renminbi bond market at a very attractive valuation. So that tells you that they are able to still get financing in this market. Of course, the QE buying of corporate bonds and how banks are lending to the corporates would also be an indication whether we are seeing further improvement on the liquidity or funding risk. Lastly, we are always monitoring the credit risk for our portfolios. And on this front, our analysts are constantly looking at stress testing the holdings that we have. But make no doubt about it is that we will see quite a number of downgrade risk in a lot of bonds, given the severe shock to the demand and supply in the current environment. But what we really don't want to see is default, right? So downgrade risk is definitely there, but we also feel that a lot of this has already been factored in by the bond price at the moment. So it's been priced in. For the default risk, a lot of them will be towards certain sectors that are very highly geared. Like I mentioned, some of the US energy sector, the single B names, and sectors that are directly impacted by COVID. On this front, we are also monitoring how much the government are going to help some of these companies that are strategic to their national agenda as well. Okay, but safe to say that for our portfolios, we don't see that there will be default risk in the portfolios at the moment, given that we think that the governments and central banks have already done a lot, and they could continue to announce more policies to help weather through this crisis.